Hello, folks. Brendan Chapman with you today. It's another edition of the Monday video for TheoTrade. Boy, it's we're getting back, and not all the world is open today, but we're seeing gold up 3%. The S&P down 3%. We have the haves and have-nots. We got about 30 minutes to the close here. We're towards the low of the session in the SPX at the moment, and it makes you wonder what's going on here, right? We are seeing a massive gold and bond divergence. We're going to talk about that, the implications, and maybe some of why gold may be moving today, and why it's been moving really since the Liberation Day announcement in terms of reciprocal tariffs. So let's dive in first. I mean, as we look at the SPY, and one of the things I do in my Ghost Prints program is we look for activity, and it could be stock activity, option activity, among other things. There was a significant print that occurred on April 15th on tax day at 538.43. And what you saw was a pivotal level develop based on that 2 million share print. We're either going to go higher and we're going to remain as that level is going to act as support, or it's going to act as resistance. And the next day we tested that level. We faded from it. We're kind of flattish on Thursday. And then over the long weekend, we gapped lower and sold off so far today. So there's a lot of weakness kind of entering the market. It looks like we want to retest lows. And one of the signals that I look at is a ratio of volatility of 3-month to 1-month volatility. And when you look at this, you're saying, okay, well, if the 3-month vol is 20% higher than the 1-month vol, that's a bearish indication. But conversely, when 3-month vol is less than 1-month vol, that should be bullish. And right now we are trading at 0.93, meaning what? The 3-month VIX is 93% of the 30-day VIX. The issue is this: when we break down and we get down below this one level like we did on March 3rd, the question becomes, is this a 5% to 10% correction, or is this more like 10 to 20 plus? And that's something I kind of addressed at the time and saying, look, which is it? My thought was we might dip closer to 20% because it's been a while and a lot of uncertainty enter the picture. My general theme for 2025 is that Mag 7 companies would underperform the S&P 500. That should drag things down. And so now we're kind of waiting below here. We're really looking for other indications. And right now, one of the biggest things that I'm looking for is to see skew. I want to see that hedges are being drawn down. Unfortunately, they're not. In fact, skew on Thursday was on April 17th was about 131. We are still elevated from historical level. I want to see something down here around 115. And that means that institutions are going to have to draw down their hedges and really want to capture the upside, because right now, with that degree of hedging, you're not, right? What you're saying is that the returns in the S&P are skewed to the downside. Yes, we could move up. Yes, we could have a high frequency of up days, but at the end of the day, there's significant crash risk in the market that remains still. And that's reflected right now in gold. Well, why? Is gold a safe haven asset? I guess so, right? I mean, certainly it holds its value. Its purchasing power remains. But normally when the market's experiencing this degree of weakness, gold is not performing that well. And then we look on top of that. Gold, generally speaking, moves directionally with bonds. If we look at the 20-year plus Treasury bond ETF TLT, Treasury bonds today are down 1.65%. That should help. I mean, that should hurt gold, right? The idea that if Treasuries have a higher yield, gold doesn't pay anything. You can lease your gold out and generate some return, but the reality is it makes bonds more competitive. It should weaken utilities, which it's doing today. These normal relationships, real estate, interest rate sensitive, it's down 2.5% today. That could those make sense, right? The bonds are down, yields are up, and it's pressuring interest rate sensitive parts of the market, except for gold. What distinguishes gold today versus past times when they tend to move in tandem? Well, since we announced reciprocal tariffs, what's happened is it has created an environment where treasuries are being sold. Why? Well, there's some reasons for that. Number one, it could be for spite. But number two, it could be just purely the fact that, look, some currencies, like the Chinese Yuan, for example, may be at risk of a significant devaluation. Well, how do you support your own currency? You have to sell some of your reserves in order to generate dollars to buy your currency to stabilize it against the dollar. Well, that means what? A lot of treasuries are held by Chinese treasuries. So those reserves are held in Europe, like Belgium, for example. Well, if we're seeing selling of Chinese U.S. owned treasuries there, U.S. owned debt held by China, sorry, Chinese owned debt, U.S. debt in Belgium, for example, we might see dollars somehow flowing into euros. And if we look at euro/US dollar, are we seeing the euro strengthening? Yeah, we are. It's kind of crazy. Well, they've cut 7 times in a row. What makes them so good? Well, they're not, right? They're struggling economically as well. And that's why they are cutting rates. But why are they relatively stronger? We're not cutting here. In fact, there's a bit of a dispute between Powell and Trump. And in fact, today, gold's advance in part is because of that potential. Okay, we're going to replace him. And you're going to cut rates? What's that going to be for inflation? What is that going to do to the dollar, the currency? Well, right now, that's only kind of exacerbating the amount of selling that's going on right now in the treasury market and in dollars. And so we're seeing some of it flow into euros, which is causing it to strengthen here. And we back this out to a longer time frame, like 5 years. We just broke the 61% retracement today. We might be en route back to like a 123 handle on the euro/US dollar, which is crazy. The dollar should be strengthening right now in face of weakness in the market. But again, this is a policy decision, right? The Fed's not coming to the rescue right now. Maybe they shouldn't. In fact, Blake and I were on today, and I ran the Taylor rule calculation using AI, Grok, for example, had him create a definition. Okay, based on current numbers, what should the Fed funds rate be? And it said 4.4%. So basically, the Fed is exactly where they should be based on current inflation rates and other factors. So why should they cut? Well, again, is Trump going to remove them, or is this just rhetoric? Are they wanting to devalue the dollar? That's been a goal, but at the same time, they want to maintain the dollar as a reserve currency. Those two things cannot be maintained. The dollar cannot hold its value and see manufacturing return back to the United States such that the trade deficits erode or are eliminated. That is going to remove the dollar as a reserve currency. And to be honest, it's not all positive necessarily to be the reserve currency. There's a lot of negatives, and we're seeing the negatives in terms of substantial debt accumulation in the United States. We consume more than we produce. Well, if we're going to flip that around, that means what? People are sending us their currency as we're not buying their goods, they're buying our goods. Now, I hope we find balance to this, right? The reality is there should be some degree of specialization. There should be some degree of working together and producing products like Japan and the United States have for many, many years. I watched Gung Ho, the old movie with Michael Keaton from the 80s. And again, you saw Japanese investment come into a U.S. auto manufacturing plant with more expectations. The reality is there's some stuff that should be produced abroad. Some of it should be produced here. We should come together and work together. And maybe that is the end goal. And if 10% tariffs are it, that's not a big deal. That's not going to change manufacturing, right? Where stuff's produced mostly. And that's exactly why we're instituting the reciprocal tariffs. This is about shock and awe about having everyone look west to the United States instead of east to China. And so this is a big deal. So is China right now having to support their currency by selling treasury holdings that maybe are held in Europe? Maybe. And you've noticed there's been more volatility in the Chinese yuan of late. Stronger here today as we're seeing selling in the treasury market and dollars being dumped, which is creating what? Higher gold prices, all things being equal. And we're breaking apart and we're seeing what? We're seeing a divergence between gold and bond prices. Normally they move in tandem. And there are instances, again, where obviously it might be tracking short-term bond prices. We're looking at longer-term bond prices. But there are no Fed rate cuts right now, right? We should see us buying in treasuries and yields coming down, supporting gold prices, and not the opposite at this point. Well, right now we're seeing maybe potential intervention in the Chinese yuan to try to support it today. Is that about to change, though? So we're seeing gold prices just accelerate its upward movement. And where are we en route to? Now, again, we might see significant 4,000, 5,000. What is gold going to be valued at in US dollar terms? How weak is the dollar going to get? Well, again, we can look at potentially Chinese stocks and say, okay, what's going to cause Chinese stocks to go down? Generally speaking, when you see the yuan weaken, We saw a peak back here in 18 of March, bottom down here on the 8th of April. Let's see what FXI looks like today in that time frame. So we go back here, right? We saw pretty significant selling. Oops, that went back a little too far here. So we saw pretty significant selling. When did we bottom down here? April 8th. Then we saw a short-term move higher. Okay, so we saw the sell-off in Chinese stocks as the Chinese yuan was selling. And when the Chinese yuan stopped selling, ostensibly when intervention came in to support the currency, we saw a bounce back in FXI and KWEB. All right, this is an internet ETF. Again, when did this bottom down here? That's the 8th right here. So as soon as the Chinese yuan began to stabilize, then we saw Chinese stocks go higher. But guess what? Let's look at what's going on today. And you look at the put side of the ledger. We're just barely sizzling here at 1.09, but 42% traded at the ask. We come down here, we look at time and sales for today. You'll see 3 significant trades. And the one I kind of focused on with Ghost Prints and are following there were these 2 prints here at above the ask price. 42 cents? No. 38 cents was the ask. They paid 42. They came in above the ask. And again, both at the same time. So they're willing to pay above the ask prices at that moment just to get filled. Probably going to fill the market. Why would somebody do that? And again, we look at FXI. If you're buying puts, you become bearish on the underlying. We look at time and sales here. You'll see 16,000 contracts traded for this week for 32 cents at the ask price. And there was more in there getting filled close to the ask. For example, 16 May 30. I haven't really vetted in terms of what the open interest is, but again, generally a buy-side bias. And you look at statistics, 58% getting filled the ask, 5% at the bid. That's selling, that's buying. And again, we're not sizzling, but we're seeing highly directional trade coming into FXI and KWEB, expecting what? Pullbacks, right? We're expecting these stocks, Chinese stocks, to pull back. Is it going to be the U.S. coming in saying, hey, we're going to delist Chinese stocks? Is it going to be China having to step in as the yuan is devaluing and causing Chinese stock prices to suffer, just like we saw back here? Who knows what the scenario is? But guess what? This is also a potential strength for gold. And if you look at GLD or GC, whatever it is you want to look at, the idea is what could push gold prices higher? It's precisely that. If we start to see a turn in the Chinese yuan, we start to see selling of Chinese equities, we may see more Treasury selling, which ultimately sees Treasury prices go down. But those conversion from Treasuries to dollars into yuan, as we're flooding the market with dollars, some of that may go to gold. And that's precisely why we're experiencing such a significant divergence. My thought process is the rally back here was about tariffs. But then it turned out that tariffs on gold weren't happening. Then we started to see weakness. And then as soon as the reciprocal tariffs began to take hold, and we saw defense mechanisms kick in of selling treasuries and selling dollars, ultimately supporting gold, this becomes a different trade than what we saw back here. It becomes a more furious upside parabolic move in gold. Where this stops, nobody really knows. Is the Trump administration okay with what we're seeing right now? Possibly they must be. Policy's not changing. And frankly, if the Fed were to cut rates, it may only accelerate the upside, as we saw today with Trump even hinting he might remove Powell. Now, is Trump the only executive branch or legislative branch member to ever talk about removing a Fed chair? No. In fact, 2008, they talked about Barney Frank, for example, in Congress, talked about impeaching Ben Bernanke, right? Ultimately, there is incentives on the part of politicians to want to see lower rates. And maybe there's something to it. Maybe we should be. The fact is we raised rates too high too quickly without taking down other liquidity measures. When the Fed cut rates last fall, it was in conjunction with reducing the size of their balance sheet, which is antithetical. You're reducing the size of your balance sheet to reduce the money supply. So why are we cutting rates? Ultimately, only Powell can answer that question. But for right now, at least he can see his policy rate decision fall within a range historically within the Taylor rule, which says that this is the current right policy rate level. I'm not saying he's following the Taylor rule. I'm not even saying he's right, but if we're applying it, at least there's something we can tie it to say, okay, yeah, maybe we are where we are. But guess what? The Treasury yield curve is inverting, right? Short-term rates are above the 5-year right now. But the selling on the long end of the curve is causing what? From my perspective, it's causing gold to increase in price. And again, if we see weakness in Chinese stocks, of which we saw rather significant put option buying in FXI and KWEB, the more pressure we see here as a result of the devaluation in the Chinese Yuan, because they're struggling economically rather significantly. It may only accelerate the need to sell treasuries, which is going to cause pressure in real estate. Yeah, we're looking at real estate retesting lows down here. It's going to cause pressure in other interest rate sensitive parts of the market, like utilities could fall back. But the one area that's generally interest rate sensitive, but right now is insensitive, is gold, because what? We're seeing a flood of dollars rolling into gold, at least for now. So again, for the moment, if you're in it and in ghost prints, we got a 330, 340 up here. We're up 100% right now. We're looking for that thing to continue to run to get to like $4, which would be close to a 250% gain. Hopefully we get that tomorrow. But the point is that who knows where gold's going right now. It could go significantly higher if this pressure remains. But just remember, as fast as we go up, you can see just as quickly prices can come down. So be careful, understand how to use options to trade gold to reduce risk and still capture the upside. That's something we do here at TheoTrade. Anyway, folks, that's all we got for today. We'll catch you back next Monday on the video. You have a great one. Thank you.